The Commonwealth Bank reveals when the property market will reach the floor. Today, we're going to look into all the details of what's actually going on. So we can see here, house price declines are actually happening quicker and at a faster rate than what a lot of economists had thought. We see Commonwealth Bank recently coming out saying that they maintain their current central scenario that house prices are going to decline from peak to trough by 15%, but they also talk about their forecasts and expectations that we actually might hit that trough sooner than our expectations. Now, they're currently expecting that we'll reach the floor of dwelling prices by mid next year, so we might hit the floor of that trough by mid 2023, with it gradually rising into the second half of 2023. CommBank talks about their forecast for house prices are conditional on the premise that the cash rate hits a 2.6% rate. This is something that they've been set on the whole way through. They've been saying the cash rate is going to peak at 2.6% and expecting that to happen potentially later this year, with another 2 rate rises coming potentially in September and October this year, and then followed by a potential rate cutting. So they're saying there could be 2 rate cuts of 25 basis points or 0.25% in the second half of 2023. Now we can see here in this graph, the CommBank has, with the rate hikes taking effect, it's had an adverse impact on a lot of borrowers and their capacity, which has a knock-on effect with property values. And CommBank said that they published in early June their property forecast with the Reserve Bank's 50 basis points rate hike, and prior to that forecast, they had revised their expectations to potentially the Reserve Bank having a tightening on their monetary policy of 25 basis points. Now, because that wasn't a 0.25% increase, it was actually a 0.5% increase. The Commonwealth Bank said that this rate hike signaled that the Reserve Bank was going to front load their tightening cycle. So they were going to try and cram it in, make it happen quite quickly. And what that's going to have as a result, they predicted that the property prices would be impacted. So in June, they wrote that they expected home prices to fall nationally by 15% over the next 18 months. And they talked about Sydney and Melbourne being the areas they anticipated to have the greatest decline in those capital areas, and expected for home values to fall significantly. But in context, we saw great gains in 2021 nationally, which were extraordinary, and therefore, the contraction in dwelling prices is a natural response to rising interest rates. So we've got to remember to put this in context, because we did see some pretty crazy increases back then, and it did have a massive impact on the market. We can also see with Domain, they talk about the fact that prices are obviously going to go down, and Domain tracked prices and rises, so rises and downturns in the property market over the last 30 years, and they found a pattern. They found that downturns lasted a quarter of the time that compared to the market goes through with a preceding upswing. And they talked about the fact that there was only 4 phases since the 1990s where capital cities had dropped. So we saw a phase in 1995 to 1996, in 2008 to 2009, in 2011 to 2012, and then 2018 and 2019. Now this downturn we're currently in at the moment is being influenced by interest rates. And when we look at the downturns over that time, we can see in some cases we didn't even hit a 10% downturn. The closest we got to a 10% downturn was in 2015 and 19, where there was a 7.9% downturn. With the bank, they've not changed their expectations on how far the downturn will go. So as I said, they're expecting that to hit 15%. And their expectation is that in the second half of next year, we're going to see the rates starting to go down. And as the rates start to go down, they might start to see the values increase with it. So they talk about the fact that historically there has been lags between the changes in rates and the impact of home prices, and that lag is actually shortening. Over the last 5 years, we've seen that happen quite quickly, and the rapid pace of tightening that we've seen with the Reserve Bank has ultimately impacted the demand for credit and, by extension, home values. And in their scenario that they've played out, they really see that there's going to be another 0.75% or 75 basis points for the cash rate to get to 2.6. And if that plays out, then we're going to see a peak in values declining and then for it to start coming back. We also noticed that values of lending and availability of credit has a huge impact on people's ability to borrow. So we only need to look 12 to 18 months ago when the cash rate was at 0.1%. For a customer that we did a capacity on, their borrowing power at that time was $1 million to 1.1 depending on the lender. When rates got up to 1.35, so that was just the previous cash rate we were at in July. So in July, when the rates hit that 1.35%, no longer able to borrow 1 million to 1.1. The same customer was only getting 970 to 980. And then fast forward when the cash rate, if it does get to 2.85, you're looking in the 840s to 846s. So you can see straight away that availability of credit is going to have an impact on people's ability to borrow. And with that in mind, has an impact on values. Now, looking at some of these graphs here, we can see a strong correlation between household lending and property values. So we can see dwelling prices increasing as household lending went through the roof on the side here. And we can also see housing approvals, owner-occupier investors, first homeowners, how that massive increase during that upbeat swing we saw in 2021 had also a massive impact on dwelling values, as well as the fact that percentage of number of dwellings that are sold, that went through the roof at the same time. Now, what the dwelling prices nationally, they're going to come down toward a downward trend over 2022. So it is expected for things to continue to go down. And that's mainly due to the impact of higher interest rates, which weighs down borrowing capacity. We talked about that just then, borrowing capacity having a huge impact on house and dwelling values. And I mean, that's another question we've got to think. Where we're at the moment, prices are already exceptionally unaffordable. We're going to see the cash rate come back down, but there's going to be a point in which, if values of properties keep increasing, people's borrowing power isn't going to be able to sustain itself. People at 6 times their income, their debt to income ratios at record levels. Will we potentially see the banks do what they're doing in England, move to a 50-year term, a 50-year mortgage loan? That's something that's being talked about. What do you think? Leave a comment below. Would a 50-year mortgage term give people greater ability to borrow, and what impacts is that going to have on the market? That's just going to keep pushing prices further and further up, because as we've seen here, people's ability to borrow ultimately determines the value of properties. And as you get more credit growth, you see values keep going up. Now, in many parts of Australia, the housing market has swung. We saw huge amounts of FOMO, fear of missing out, in 2021. This is being brought on by fear of getting in. And that in itself is starting to see a self-fulfilling prophecy. And it's been identified that prices will stabilize and they might actually rebound at some stage. Now, there's nothing at the moment with expectations, given that the Reserve Bank and where that cash rate lands will ultimately determine some of these factors. And it's worth noting that the CBA, from a cash rate perspective in the community, is probably on the lower end and the more conservative on the forecasting range of the community. Of 20 economists that were interviewed recently, they all averaged out, assuming the cash rate would get to that 3.1%. We've seen on the high end, Westpac saying 3.35. We're seeing on the low end, CommBank 2.6%. So all these assumptions are based on the cash rate getting to 2.6%. Once it hits 2.6%, Commonwealth Bank's call is that the cash rate will go back down in the second half of 2023 by a further 0.5%. And it just gives us an idea. CommBank's also talking about dwelling values. Sydney in 2021 increased by 25%, Melbourne 15%, Brisbane a massive 27%, Adelaide a massive 23%, Perth a massive 13%, Hobart up 28%. 2022, they are expecting the values to go down. Sydney and Melbourne being the bearer of the biggest brunts of these downturns, 14% and 12% respectively. Brisbane down 2% for this year is predicted. Adelaide going strong, up 8%. Perth down 2%. Perth up by 2%. Hobart down by 5%. And leading on to 2023, where we might see Sydney actually neutralise, no losses, no gains. Melbourne down 2%. Brisbane down a further 6%. Adelaide down 7%. Perth down by 5%. And Hobart down by 8%. I mean, cumulatively, peak to trough, we're going to see anywhere from an 18% reduction in Sydney, 17 for Melbourne and Brisbane, 11 for Adelaide. Putting in that into perspective, when you've seen 25% gains and 27% gains, is that really a big deal? We're seeing a contraction. We're not seeing a massive crash. I think, once again, guys, here at Hunter Galloway, we help with home buyers around Australia. You need assistance with a mortgage, hit us up at huntergalloway.com.au or call us on 1300 088 065, and we'll see you next time.